What if the future of money looked like innovation and freedom, but felt like control and surveillance? The recently passed Genius Act creates the first comprehensive federal framework for regulating dollar-pegged stablecoins. Don't worry if you're not familiar with what stablecoins are. I'll cover all those bases in a minute. Whether stablecoins gain wide adoption or not, the Genius Act sets a precedent for how government will regulate all future digital payment systems, potentially affecting everything from how you move money overseas to whether your financial transactions remain private or more exposed in an increasingly digital economy. The Genius Act no doubt has some important and welcome reforms relating to the acceleration of decentralized finance, DeFi as the purists call it, and digital assets. Yeah, things like cryptocurrencies. Yet it remains to be seen if this ends up being political theater and another example of governmental overreach designed to stifle the decentralized appeal that really was the birthing of cryptocurrencies in the first place. Hello, I'm John Llodra with New Harbor Financial, and today we're diving deep into stablecoins and the new Genius Act that just passed the Senate. Over my nearly 25 careers as a financial advisor to everyday people, I've seen many new regulations and so-called innovations in the financial industry. I'll use this video to break down the practical implications of the Genius Act and the rise of stablecoins on your financial future. But let's first start with the basics. What is a stablecoin? A stablecoin is a form of digital currency, also known as cryptocurrency, that pegs its value to a specific unit of value. Most often a fiat currency like the US dollar, but technically could also be keyed to another thing like a commodity like gold or even other cryptocurrencies. When most people think of cryptocurrencies, they think of widely adopted vehicles like Bitcoin or gimmicky coins like Dogecoin, or even political vanity coins like Trump coin. Whatever the case, most people equate crypto with extreme volatility in price, which is pretty much warranted based on the price experience so far in most cryptocurrencies. However, the purpose of stablecoins is exact opposite. They're specifically meant to be stable, not volatile in price. And while technically stablecoins can also be pegged to the value of commodities like gold or crypto, my take is that these examples are really just oxymorons of the grandest sort, since the price behavior of these types of assets are anything but stable. Instead, we're going to focus here today on stablecoins pegged to the US dollar, which is also really the focus of the Genius Act. You can really think of stable coins pegged to the US dollar as a form or an intended digital equivalent to widely used money market funds, which also aim to maintain a one-to-one peg with the US dollar. But here's what makes stablecoins significant. They're gaining massive adoption, not just in the US, but also in foreign and emerging markets where people are looking for stable mediums of monetary exchange. So the key question is, what do stablecoins promise that our current system doesn't? In other words, do we really need them? To help answer that question, I'm going to refer to this chart that was put together in a recent report by McKinsey and Company. And the bottom line, the big picture takeaway is there are so many arcane and inefficient aspects to our traditional banking system that these digital stablecoins are intended anyways to solve and relieve those constraints. So on various measures, speed, cost, cross-border transactability, automation and innovation, security, transparency, settlement risk, and availability, all these in some way or another, stablecoin promises some really tangible benefits. We truly believe that. So for example, just on the speed, we know that sometimes it can take 1 to 5 business days to transfer funds. We're in the business of transferring funds for our clients every day, and new clients transfer their funds to us. And it's really puzzling sometimes how it has to take so long. And even things like availability. So many financial transactions are constrained to when the banks are open. They're not open typically on weekends or on major holidays. Even the US Postal Service is making deliveries on Sundays for people like Amazon. To think that our banking system is constrained like that. Stablecoin offers a 24/7, 365-day-a-year, nearly instant settlement potentiality. There's a lot of innovation still to have, but the point being is there are some really credible and tangible benefits that stablecoin may offer. So those are the at least purported or anticipated benefits, but how widely adopted have stablecoins become? This is a really interesting chart that was in a report that was put out by the Bank for International Settlements. This is essentially the central bank to central banks. And what we see here is in the leftmost pane, this shows the number of stablecoins, the actual number of different issued stablecoins. You can see it started off from essentially 0 before 2018 and has skyrocketed to well over 150. individual different stablecoins. That is a meteoric rise. Perhaps even more eye-popping is the amount of money, assets that have flooded into stablecoins. You can see here from essentially zero, we're now approaching $250 billion, and this is as of May of 2025. Now, I want to point out, you can see there are two colors here, two specific stablecoins that constitute the vast majority. We have USDT, which is a stablecoin that goes by the name of Tether. Might be familiar with it, but it's the largest stablecoin out there. And then there's this one USDC, which is issued by a company called Circle. Those two together constitute the vast majority of US dollar pegged stablecoins. And this is all prior to the passage of the Genius Act. Now, in terms of what the stablecoins that are talked about here are denominated in terms of the number of stablecoins, 68%, slightly more than 68% are pegged to the US dollar. You can see there's only, at this point, 6.37 pegged to commodities, 3.82 pegged to other cryptos. For all intents and purposes, those are elements that we consider more or less irrelevant. We're really focusing on the US dollar pegged stablecoins. And even more, I think, important is the dollar value of stablecoins. Almost 99% are in US dollar denominated stablecoins. So they are definitely catching on. Definitely the vast majority are US dollar denominated. The key question is, how pervasive are these actually being used in everyday transactions? You know, people buying and selling things online. And here's where a little bit of nuance comes to the fore. These are some interesting charts that were contained in Michael Sembelis from JP Morgan's recent Eye on the Market. And the left here shows in trillions of dollars, we're talking about big dollars here, the transaction volume in stablecoin. You can see rocketing up here, stable it off here, and approaching the volume purportedly of a company like Visa, which obviously is a huge payment processor through their credit cards. The devil is in the details here. What the right pane shows is the actual volume of money that's used for actual trade. And you can see this is a much smaller scale. It's on billions of dollars. So you can see closer to 70 billion. Far cry from the trillions of dollars that are on this other slide. Now, what's the difference? The key difference here is still today, most of the transaction volume in stablecoin is contained within the cryptocurrency universe. Not for everyday purchases and transactions, but for moving between cryptocurrencies. So arguably, the volume really hasn't taken that far off. But we think the Genius Act and the further innovations there and regulations will likely lead to a much more profound use of stablecoins in everyday commerce. So this all sounds well and good, but we always focus on what could go wrong. What are the downsides? The key here is, again, we're talking about US stablecoins, US dollar stablecoins. The key feature there is that they are pegged to the US dollar, and they have the reserves to back that up. And that's where things can go wrong. In fact, we have a very specific example. In May of 2022, a stablecoin by the name of Terra Luna absolutely collapsed. Now, this was a unique situation. This is what was called a algorithmic stablecoin. But essentially, instead of having the reserves, they had an algorithm that would adjust the holdings based upon supply and demand. This met a fate that you might even say was possibly expected. $40 billion of investor capital in that stablecoin was wiped out, and it had carryover effects to the broader crypto landscape, where there was about a $400 billion decline in crypto assets globally. Big event. But even more legitimate fiat-backed stablecoins have gotten into trouble. Take Tether, for example, by far the largest US dollar denominated stablecoin out there. It's actually domiciled in El Salvador, and it's used heavily there and in other places. Well, Tether was actually banned by the New York Attorney General in a lawsuit that they made claims and found that Tether made misrepresentations in terms of whether they actually had the US dollar reserves to back the stablecoins that they were issued. And so Tether has all but been shut off from the US, especially in New York. Now we'll see what happens in the wake of the Genius Act as to whether they come back. I think they're planning to come back in compliance with that rule, but remains to be seen. This is all eerily reminiscent to a few times in history where money market funds, the things we have traditionally thought of as safe assets, have also run into problems. Back in September of 2008, I know it's a long time ago, it was in the peak of the housing crisis. Well, a very large money market fund called the Reserve Fund, so-called broke the buck. The value of that fund dropped below $1 per share, and it had to be bailed out, basically. So this is a key risk. And in fact, I want to call out a video I did. I did a whole video on whether money markets are safe, and especially after some law changes that were kind of stealthily adopted about a year ago under the radar. In a nutshell, I don't believe all money market funds are created equal in terms of safety. And that's not a problem until it is, right? Until we have the next financial crisis. But the point is here, stability isn't guaranteed, even with traditional financial instruments. So we have to consider that a potential risk here in these new and novel stablecoins. Now, hopefully the regulations will help make those safer, but it's still something we need to be cognizant of. So let's get back to the Genius Act. What is it saying that it's doing? First of all, let's talk about, it's a nice name. Politicians have a great way of picking names that are provocative and sound all peaches and cream. But what does Genius actually stand for? It stands for Guiding and Establishing National Innovation for U.S. Stablecoins of 2025. How's that for a mouthful? So it just passed the Senate, and it was part of a very hyped up so-called Crypto Week in mid-July of 2025. There were other pieces of legislation that were being floated around that didn't get acted on, like the Genius Act, but those other legislations, one was so-called anti-CBDC, Anti-Central Bank Digital Currency Act. Didn't get passed, but it's still on the docket for future action. And the key point of that act was to essentially say, no, Federal Reserve and central banks in the world, you can't enter the money market. That's a breach of your charter. It's not good for consumers, not good for financial markets. So the intent there is to keep the Federal Reserve out of issuing central bank digital currencies. That made a lot of news in recent years, where there were actually papers and proposals floating around the world's central banks for exactly that. So this is, on the surface, something that we would celebrate. We don't believe that central banks have any business being in the business of issuing stablecoins like that. They already have plenty of power in being able to print money at thin air by the stroke of a computer keyboard. The next one is the Clarity Act. This is a piece of legislation that's like the Genius Act, but to be applied to all other cryptocurrencies, things like Bitcoin, other non-fiat peg, non-US dollar pegs, cryptocurrencies. So let's get back to the Genius Act. Here are some key provisions. First, registration. It requires that any issuers have to register and meet regulatory requirements in order to become what's called a permitted stablecoin issuer. PPSI, as it's abbreviated in the Act. A big part of the Act is aimed at consumer protection. It requires that stablecoin issuers must have reserve assets of at least 1-to-1. And these have to be in very safe, legitimate forms, things like treasury bills, money market funds, repos, things like that. These are all things that, for example, traditional money market funds are allowed to hold. And again, the key is it has to have at least 1-to-1 backing. So there has to be demonstrable reserves, at least as much as the purported value of the stablecoins outstanding. The bottom line is no funny business with the reserves, no speculation, no commingling of customer funds with exchange funds and things like that. Another key part is disclosure requirements. Issuers have to publish monthly reports showing their reserves and the composition, how many stablecoins are outstanding. And very importantly, there's got to be very clear procedures for redemption of stablecoins. Another key aspect of the Genius Act was that issuers cannot rehypothecate, meaning lend out to other parties, the reserves that they hold. In addition, they can't use those reserves as collateral for other investments or loans or anything like that. Quite simply, the money has to be there, at least 1-to-1 ratio. Some other provisions, legal priority in a bankruptcy. If by some stroke of events an issuer goes bankrupt, the token holders or stablecoin holders, as they're called, will get priority over general creditors in a bankruptcy. Whether that matters at the end of the day, who knows, but it's at least on paper an important legal protection. The compliance provisions, the issuers here have to be bound to what's called the Bank Secrecy Act compliance provisions. This includes things like filing suspicious activity reports, like many banks have to do, anti-money laundering rules and things like that, but it falls short of broad-based banking regulations. So that's possibly an area that we should have some concern, because there could be all kinds of loopholes and games being played there. But importantly, stablecoins per the Genius Acts won't be defined as securities or commodities. So what that means is they won't fall under the jurisdiction of the Securities Exchange Commission, like stocks and bonds and mutual funds and ETFs do, nor will they be regulated by the CTFC, the Commodities Futures Trading Commission. Instead, they'll be regulated similar to companies like PayPal. Bottom line is the stated goals are to facilitate the safe and protected adoption of digital assets in the US and around the world. Sounds reasonable, right? But what's really going on? Is it really about innovation and removing frictions in the arcane banking system, or could there be some ulterior motives? I want to talk about some of those takes that I think are certainly part of this legislation. The first, because this is expected to dramatically increase the demand for US dollar stablecoins, not only here in the US, but perhaps even more importantly across the world. We still have the world's reserve currency. People want to have dollars to transact, whether it's for oil or other goods and services. We still are the global reserve currency. In fact, this might be viewed as a self-serving measure by the US government to create additional and sustained demand for US dollars, a very large source of new demand. One implication of this is, like with any demand for assets, or bonds, for example, when there's buying demand, it puts downward pressure on interest rates. So it could be a very not so subtle way for the US government to try to put downward pressure on the rate at which it borrows money to fund operations. It's a rhetorical question here, but when you look at the fiscal recklessness that we have had in our country for many years, and this cuts across both political parties, it's a fair question to ask whether it's a good or bad thing when we're basically greasing the skids for further fiscal irresponsibility by creating this demand for US dollars and US treasuries. I don't have the answer to that, but it's just something to be noted here. It may just be another mechanism to kick the can down the road. Another key thing is, because it falls far short of the broad-based banking regulations, it actually can enable non-banks to enter with a fraction of the regulations. So there are things like there's no federal insurance programs like FDIC in the Genius Act. Are there perhaps exposures to depositors, so-called depositors in stablecoins? Sure, I think that could be a major issue. There are no third-party audit requirements, but there is a risk that there could be a flight of capital from banks into these stablecoins. For example, there are provisions in the Act that prohibits a publicly traded company that's not otherwise predominantly engaged in financial activities from issuing stablecoins. For example, a large tech company can't just come in and issue their own stablecoin and call themselves essentially a bank without being subject to banking regulations. But there's a loophole, because there's what's called a committee, the Stablecoin Certification Review Committee, which is, let's face it, just another bureaucratic committee that in theory any company could apply to and be approved to become a stablecoin issuer. Call me jaded, call me suspicious, but given how things have played out in history, I think that's an area that's rife for abuse and manipulation and conflicts of interest. Here's another key aspect of the Genius Act. Issuers of stablecoin can't offer a yield. So on the surface, it seems to say, hey, we don't want money to bank deposits to flee the banking system, because banks still offer a very important role in creating credit for business loans and other personal financing needs. That can get to extreme and irresponsible extremes at times, like we saw during the housing crisis, but it's still a very important element of our economy to be able to invest and build a business on credit, for example. Now, because the Genius Act prohibits stablecoin from offering a yield, it's arguable that the money would still stay in banks to earn that yield versus flow en masse to stablecoin. Now, of course, if we get back down to zero interest rate policy like we had in the wake of the great financial crisis, that's a moot issue. Here's the hook. There are loopholes that other intermediaries and even affiliates of the issuers can issue a yield. So it seems like there's a very easy runaround in my quick read on this prohibition of offering yield on stablecoin. Another key area that I think is an area for potential concern is the rules around foreign issuers being able to issue US dollar stablecoins. Basically, there's an element in the Genius Act that says, hey, if you're domiciled in a foreign country, and so long as your country has a similar set of rules, equivalent set of rules, and a very subjective determination of that equivalency, you don't have to be bound by the Genius Act. You can kind of operate under the rules of your country. That, to me, speaks of rife for abuse, loopholes, bureaucracy, all that kind of stuff. So here's the question. Do the very legitimate, innovative, and efficiency-minded aspects of stablecoins start as innocuous thing, but really turn out to be a form of control? I really think that's a key risk. In recent years, there's been very vocal talk about central bank digital currencies. We're still talking about a system that can easily be kind of controlled by policymakers. For example, in the wake of the COVID stimulus payments that went out en masse to people and businesses, policymakers started floating the concept of, hey, next time when we do this helicopter money kind of stimulus, we want to have tools that we can target to specific narrow parts of the population, and even more to specific purchases. Like, hey, we only want you to be able to spend this money on these goods and services, all of which speaks to command and control. When you consider the fact that the IRS gets all sorts of details regarding activities, for example, in your brokerage account, it's not at all a stretch to imagine a scenario where the IRS and other government agencies agencies can know to the penny where any individual spends their money and on what goods and services. That to us reeks of possibilities and likelihood of abuse and government overreach. So this is something we want to be very open-eyed about. It's not all great things coming out of it. We think there are some deviant factors that can come out of here. So, no doubt about it, we're looking at a fundamental shift from traditional financial economy to a digital economy. I don't think that train is going back in the station. We just want our clients and viewers to be open-eyed and just be very aware of the details here. I didn't talk much about broader cryptocurrencies today. Things like Bitcoin and other cryptocurrencies that we think will only be helped or aided by more proliferation of stablecoin US dollar-backed currencies. We're going to do, my partner Mike Preston will likely do a video more broadly on cryptocurrencies in the coming weeks. So keep an eye out for that. Bottom line, Genius Act, a lot of welcome aspects here in terms of consumer protections and regulations and clarity on that. But there's a lot of things here that we think still need to be nailed out and should be looked at with a skeptical eye, both by our politicians, but also just everyday people like we serve every day. So I hope you found this video helpful. Please leave your comments, questions in the notes to the video. Please feel free to share it. I invite you to subscribe to our channel here. Hit that little bell icon. We put out content nearly every week, sometimes more than once a week. And that's the best way to get alerted when we put this content sent out. Again, I hope you found this helpful. I thank you for watching. And until next time, I want to wish you a great day. I invite anybody here viewing this video to give the team here a call at New Harbor. Our contact info is in the notes to this video. Happy to have a no obligation conversation about this or any aspect of your financial life. We've got CFPs, certified financial planners on staff. We have a very hands-on tactical investment approach that's really meant to first and foremost provide risk management and protection of your hard-earned assets. But we'd love to hear from you and invite your calls anyways. Thanks again. Have a great day.